Okay, so example 2. Refer again to your financial statement handout for Super One Corporation. Construct a pro forma balance sheet for 2021. All of the same assumptions from our previous example. We're going to solve for what the net funding need is for 2021. So again, we're going to write pro forma 2021. We're also going to write ratio or formula because there's so much stuff that I just kind of want to keep track of everything. So the first ratio, we've got our cash. We're going to assume that that's a fixed portion of our sales. Sales 2020. We've got our accounts receivable. That's going to be a fixed portion of our sales from 2020. We've got our inventory, which is going to be a fixed portion of our cost of goods sold. We've got our net property, plant, and equipment. So this is going to change by the PPE from time T plus our CapEx for time T plus 1 minus our depreciation for time T plus 1. We have our accounts payable, which are going to be a fixed portion of the cost of goods sold. And then we have our long-term debt, which we're going to assume is unchanged. And our shareholders' equity, which is going to increase by the shareholders' equity at time T, plus our net income for time T plus 1, minus our dividend for time T plus 1. So let's solve and see what we're finding. Okay. So first, for my cash, I've got the ratio. I'm going to multiply that by my projected sales for 2021. For my accounts receivable, I've got my ratio. I'm going to multiply that by my projected sales for 2021. And for my inventory, I've got my ratio. I'm going to multiply that by my projected cost of goods sold for 2021. When I sum these up, I've got my total current assets. For my property, plant, and equipment, I'm going to take the value from last year plus the 60 million. We assume there's going to be a 60 million capital expenditure minus the depreciation that's expected for our pro forma. So this is going to equal that. My total assets are going to equal this, my total current assets, plus my total long-term assets. Okay. My accounts payable, it's going to equal my ratio multiplied by my cost of goods sold, my projected cost of goods sold. My long-term debt, I'm going to assume is unchanged. So my new total liabilities are going to equal my total current liabilities plus my long-term liabilities. And now I've got my shareholders' equity, which is going to equal my shareholders' equity last year plus the change in retained earnings. So I know I'm going to have a 200 million dividend. I'm going to add the net income for my pro forma year. So when I sum these, I'm going to have the sum of my total liabilities and my total shareholders' equity. Okay, so what do we notice? We notice that my total assets equals 2234, and my total liabilities plus my equity equals 2179.68. What does that mean? Well, we can observe that my assets doesn't equal my liability plus my equity. My assets are going to be bigger than my liability plus my equity. So to figure out my net funding need, I can take my total assets and subtract them from my total liability and my total equity. When I do that, I find that we have a net funding need of 54.92 million. So we will issue long-term debt to meet our funding need of 54.92 million. Okay, so we found that our funding need for 2021 was 54.92 million. In the examples that are uploaded on Blackboard, what I want you to do is to also try this on your own and see what you're finding. Okay. This example is useful because it shows how much additional debt we would need to issue to balance our pro formas. But the debt could also be at capacity, meaning that the firm is levered and we don't want to issue more debt. Then things get a little bit tough. We could cut our dividend, which is bad news because if the dividend's expected, it's a very negative signal to shareholders. We could dip into cash reserves, which is also risky because we might be saving our cash for precautionary funding needs, i.e., we might be expecting things to get really bad, and that might be our cash that we're holding on to just in case we're not able to go and tap capital markets. We could also issue more equity, which could also send a bad signal to the market. Typically, when a firm decides that they're going to have a seasoned equity offering, an SEO, you'll find that they have a negative announcement return of anywhere from 2 to 4%. So it can be very costly to let the market know that we need to go raise more equity to meet our funding need. Pro formas are useful for obtaining estimates of future cash flows. Our future cash flow for time t+1 is going to be our operating cash flow minus our CapEx minus the change in net working capital. And remember, net working capital is your current assets minus your current liabilities. CapEx stands for capital expenditures. And the free cash flow is going to represent all the cash that's paid out to bond and stockholders. So remember, the value of the firm, as we've been doing over and over, can be calculated as the present value of these future cash flows. What is the projected free cash flow for 2021 for Super Corporation? So after you've found these pro formas, after you've made a pro forma income statement and a pro forma balance sheet, you have all the information needed to actually identify the operating cash flows pro forma for 2021. You know the CapEx for 2021 is going to be 60 million. You can also calculate the change in net working capital given this pro forma. What is the value of the firm today? Assume a discount rate of 10% and assume that the free cash flow will grow in perpetuity at a rate of 3% per year. So this will be the example that you solve once you've actually worked through the income and the balance sheet pro forma. In conclusion, this is going to complete our lecture on constructing and analyzing a pro forma financial statement. This is such a useful tool for forecasting. If you do anything in terms of being an analyst or working in the treasury of a firm, working in a non-for-profit, any line of business that you'll put your hands on, having the ability to identify what will be our funding needs given our projection of sales is crucial. So this is a tool that you will use in finance and you'll use in business forever. It's very useful for calculating future cash flows and for identifying the value of your firm, which is why you use it over and over for valuations. So as I said, uploaded right now on Blackboard, you have an example of the same income and balance sheet statements that we just worked on together in the video. I want you to do it by yourself. make the ratios, get used to clicking around and seeing where things go. And then you should be able to identify all of the information needed to value the firm. Next week, we're going to move on to financial options and also to real options.